Good morning, everybody. My name's Anthony Machin, and I'm going to take you through Glass's monthly webinar. I changed the setup a little bit, but we're going to go through a number of different things that are currently affecting the market. One of the main things, of course, is lockdown. So we'll look at how lockdown is affecting the UK market and how we can move forward into December. So what I'm going to look at today is the UK and the coronavirus. A little bit on Brexit again, because that is starting to loom quite quickly as we move towards the end of the year. We'll look again at what the market's been doing over the last month or so. I've got some slides around battery electric vehicles, what's coming soon, but also a quick look at electricity prices and how the electricity prices will vary significantly and can actually look at the total cost of ownership in quite a lot of detail with those prices. We'll go through a bit of a summary and then I'll take you through next steps as well, just to look at how you can contact us and how things at Glasses are changing over the next month or so. So if we look at the pandemic, unfortunately, the amount of confirmed cases in the UK rose above 1 million last week. And of course, the sad news there as well is that deaths do continue to rise. But let's look at the lockdown in England particularly and how that's affecting car sales and car dealerships. In England specifically, showrooms are closed and any other premises, including outdoor areas, used for the sale or hire of caravans, boats or any vehicle which can be propelled by mechanical means. So effectively that covers all of our data sets from cars, LCVs, caravans, motorhomes, and holiday homes and holiday home sales. Incidentally, car washes are also closed, so we will need to get the bucket out on a Sunday. What do remain open are things like petrol stations, car repair and MOT services, storage and distribution systems, and facilities for moving vehicles around, and anything that's not included in this part. Essential retail, click and collect and deliveries are still permitted, which is key for sale of vehicles moving forward, because a number, or pretty much all, I think, dealerships now have got some kind of click and collect system for both new and used vehicles. In Scotland, car dealers are open. In Wales, the dealerships closed but now open again following their fire break. And in Northern Ireland, car dealerships remain closed. But what does it really mean? Well, in England, lockdown 2, from a business perspective, it's just an unwanted distraction. Yes, things have slowed down, the consumers aren't coming in quite the same way. But over the last few months, we've proved the auto market is definitely resilient. Dealers and finance companies know now what to expect from lockdown, and especially this second one, which is possibly not quite as draconian as the first. And they are much better prepared. They know what to do in terms of the constraints that we have. They work safely. There's minimized infection rates through their business activity when they're seeing customers and when they're working together in the activities that they're currently doing. And they're serving customers by removing any fears that they may have by coming into the car dealerships. Now, in terms of what we're thinking, we're expecting November and December, they won't be as busy as the summer months. But we also don't think the market's going to slump to where it was in April. There's a lot of confidence still out there and people still want to buy new and used cars and LCVs. Customers will continue to buy and many are using the click and collect facilities that dealerships around the UK and leasing companies have laid on for customers. But one thing to bear in mind is where the employment levels are moving to at the moment. Now, I got this data from the tax authorities in the UK, and it's quite interesting because the blue line is effectively the labour force survey, or where we are in terms of the unemployment numbers, and they've not really dipped as much as we would have expected them to. What has dipped, and I think this is important moving forward as we look for people to return and start buying on a regular basis and reservicing cars and making sure their leases are up to date, is that the PAYE, the pay as you earn, real-time information has really fallen off this year. That means the number of people effectively paying tax as they earn. So that's just something to bear in mind, that this is the weakest it's been for, you know, quite a number of years, way back to 2016 really. If we now sort of turn to Brexit, I've used this slide for a few months now, but major difficulties still remain. Now, what we are working on and monitoring is really what we're looking at in terms of average price increases as we move forward. Now, this graph just shows by year. What my team is working on, and I hope to present next month, is how we are looking at pricing through this year and how pricing has changed versus last year. Now, the squiggly lines just show a slowing of the increase. So between 2019 and 2020, the price increases in the average used retail price slowed to maybe sort of 3.5% increase versus 2019. And the same has been true of increases in new retail prices. They've really slowed, and the increase this year has only been about 5.7%, the same as 2019. But you can see from the graph, new retail prices continue to rise and used retail continues to rise. And if we do have a no-deal Brexit, we will continue to see we will see a significant jump in new retail prices. The same will not be true straight away for used retail prices. We envisage they will continue on their same trajectory and perhaps slowly catch up, but the residual value as a percentage could actually will we believe drop significantly next year. What we are doing as an organisation, because data is coming towards us quite quickly, we are taking on board the OEM price lists and making changes to our database. Now, at the moment, we are also receiving the price increases for Brexit, no deal, from manufacturers, and we will make a call as to whether that data goes live, obviously at the end of December, beginning of January, to make sure our databases are as up to date as possible across all of our products, both the applications that we release to you like LastNet, but also our data only products, which a number of you take from us on a monthly basis. So let's look at 2020 market realities. Obviously, this year has been significantly affected by Corona and COVID, and the close down this month, the lockdown this month is also affecting where we are looking. The values are going to be moving forward in this month. As we look at our values for December, the data is relatively scarce, particularly from retail, but hopefully as we move through the month, we will get more data, so to make sure that we are as accurate as possible for our December guide values. So from a new car perspective, we can look at the results from October. October was down again by 1.6%. And it's quite interesting. So only down 2,306 units versus 2019, but it is another month where we've seen a decline. Only in July this year have we seen any increase against the 2019 registration results, which is disappointing. I know we've been in lockdown. I know COVID has affected significantly the car market, but the catchback that we have had is positive, but it still leaves us significantly behind last year at minus 31% at the end of the year. At the end of the year, it's likely that this will be about the same, mainly because the lockdown this month, with registrations continuing, but to a smaller extent, and December we're unlikely to see significant catchback because of the shortness of the month due to the Christmas holiday period. So at the moment, October year to date down 31%, and overall we are down 620,000 units versus 2019. So quite a significant change in where the car market fortunes have led this year. Now, in terms of the fuel type split, I find this quite interesting just to see where we're going. On the right-hand side, the pie chart shows 2019, on the left-hand side, 2020. Now, if we look at the pink sector, That's petrol, including the mild hybrids. And there's not been a huge change. It's changed from 66% in 2019 down to 64%. Where the biggest change has been is in diesel. That's the blue segment, which has declined from 27% down to 20%. And the increases are in the alternatively fueled vehicles, the hybrids in green, up from 6% to 11%, and the BEVs in the grey colour, with the really large increase from 1% to 5% of market share. So it's a real sort of increase for the alternative fuels, and that the issue there will be as we move through is that CO2 is still quite high coming out of petrol engines, and if we're looking for a CO2 reduction, the manufacturers for CAFE, it becomes quite an issue. Hence the implementation of a lot more mild hybrids on the petrol to reduce CO2 further, but diesel is still the best sort of the emitter from a CO2 perspective. Obviously, emissions of particulates are a different story there, but yeah, CAFE could still be issues as we move forward. From an LCV market perspective, I think it's been quite an interesting few months. Since lockdown finished, there's been some quite high increases. August accepted, but in July, the market versus 2019 was up 7.1%. In September, up 26.4%. And even last month, although it slowed down a bit, was up 13.3% versus October 2019. That's an additional 3,380 units, so a real positive for the LCV market. Where it leaves it year to date is also quite impressive. You know, bearing in mind the market was paused March through sort of the end of May with catchback, and I know we've closed down this month, but real positives. And we're seeing that the new LCV market is really being driven by deliveries of Amazon, deliveries of food from the main supermarkets, but also rental vehicles. That's really not seen at all in the car market. So maybe shopping Waitrose, maybe shopping Tesco, but you'll see a number of where they're storing the vehicles overnight, particularly like local Waitrose. They have one or two rental vehicles on site overnight for the delivery of Waitrose goods. So I think where the LCV market has gone is fixing short-term issues, but those short-term issues will become a long-term strategy for all of the supermarkets as they expand their LCV fleets. What we're seeing is a slowdown in real quality coming to the wholesale market, and that's what we're going to touch on now. So if we look at used cars and the LCVs, we'll first of all look at the retail market. So from a retail perspective, this is across Europe. This is all vehicle types, so it throws in LCVs and cars into these numbers. We can see that the UK in red has risen significantly since lockdown finished. Now, what we've seen is that it rose to the real highs at the end of September, but has slowly started to slow down. And we're seeing that as we look at data from the retail market, but also as stock has increased in the trade, the wholesale market also started to slow down a little bit. But you can see here we recovered much more quickly than the rest of Europe. A lot of it was down to the jump back in demand as the pent-up demand became available. But people were really shopping heavily on used retail and really wanted to buy cars. And the best cars were really gaining in price significantly. Now we project, and this is part of our RV white paper that I can, when you download the PDF from the website, you'll be able to download our white paper. We believe that by the end of the year, we'll become almost parity, a little bit below parity with the start of the year in terms of our RVs, mainly because of November and the slowdown in the market in November. If we look at the price index by age, this is just for the UK market this time. And you can see the biggest slowdown has really been in the older age groups, the over 91 months, the 54 to 90 months ones here. But the overall is 105.3. And the other green one, the 18 months, so 3 year to 5 year kind of age gap. The younger cars are the ones that haven't really recovered overly quickly, but are also starting to dip down. And this is where we will see the residual values really starting to fall a little bit through November and December, we believe at the moment. If we look at stock and how stock has sort of improved, our stock days have improved. Obviously, this is the left-hand side is for car, and the right-hand side is for LCV. There's been a real sort of increase, and this increase was obviously towards the middle of June, and then we started to see real decline, quite rapid decline, as shoppers, as retail customers came into the retail showrooms and bought online, and the days in stock really declined very rapidly. What we're seeing right now in both LCV and in car is that the days in stock are starting to increase again, but still very positive and very, very positive for the time of year. So really good news as we move forward for both the car market and the LCV market. Now, this is something I do quite like to show. This is the fastest selling used cars in October from retail observations of at least 50 vehicles being sold. The fastest seller was across the UK was the Infiniti Q50, average days to sell 20 days, and actually average age was actually relatively low along with the average mileage. Now, Nissan Pathfinder has crept in once again. We quite often see the Nissan Pathfinder in our data, but again, this is kind of a real value-driven vehicle. Just under £8,000 transacted price, and quite old, 135 months. Chrysler Epsilon, the sister of the Lancia Epsilon, not too many around, but obviously more than 50 retail sales last month. 21 days to sell. It's a bargain price. Not massively old, 90 months old, but still relatively high mileage. But interestingly, two convertibles have actually made it into our top sellers. So people are still willing to buy in as we head into the depths of autumn and possibly the start of winter. Are still happy to buy convertible vehicles, which is quite interesting as you look at your stocking mix. It's really very unusual, but this year has overall been very unusual. So we're seeing very different things. And for MX-5 and A4 Cabriolet, albeit the A4 Cabriolet is quite a bargain vehicle that we're seeing, it's quite interesting that people are still willing to buy cabriolets at this time of year. So moving on to the wholesale markets. We've got the sales volume of cars at the top and LCVs at the bottom. You'll see that cars have just remained above 2019, the pink line, 2020, the blue with the square separators for the month. So just ahead still of the volume sold in October last year. But overall, the last few months have been really positive in terms of volume of sale in the car market. For LCVs, again, really popped up very high in June and July. August dipped a little bit. September was okay, but October has fallen a little behind October 2019, but still very positive for the end of year. Unfortunately, I think we'll see. I'm hoping that we can stick to 2019 levels, even with the lockdown in place, because the main auction players in the market are retaining or staying open through the English lockdown, with deliveries taking place and pickup collection is still available just as it was over the last few months. So hopefully we can see lots of data coming in from the auction centres as we move forward. For the wholesale pricing, again, cars at the top, LCV at the bottom. October stayed for cars 26.9% above October 2019, so real positives, and stayed positive for the majority, or actually all of the year, in terms of cars, so above 2019. For LCVs, a really, really positive story. Again, the LCVs that in the used market that customers are looking for are retail ready stock, and they are gaining in price each month that we've seen the data coming back for. Some real positives in the LCV market. Yes, from the new side, the supermarkets and the larger delivery companies are looking for new LCV vehicles. On the used side, the likes of the Amazon delivery drivers are looking for good, ready-to-use vehicles, and that's what the trade are really able to sell at the moment in LCVs. So a really fascinating story, and that's across all LCV sectors. You know, even the pickup sector has been doing very well this year, but predominantly it's the medium-sized vans, the likes of Transporter and Vivaro, but also the Caddy and the Connect size vans are doing very, very well at auction. Just a caveat on that, it's still looking for the best possible stock. Usually on the larger vans, it's more difficult. So, but vendors who have great size, you know, Crafter and Sprinter type vehicles are doing very well as well. But if it is, condition remains key in car, but especially in LCV, if you want to gain the best prices at auction. Okay, that's the end of the market update. I just want to look at electric vehicles. Now, these are close to my heart. I drive an electric vehicle on a regular basis. I'm still looking for my next electric vehicle, but more and more of these vehicles are coming out, and both the LCV market and the passenger car market. But it's interesting as we look at these, who's bringing them out and where they're going to be used. Now, I think Vauxhall, and part of PSA now, of course, has recently announced an excellent tie-up for their Vivaro EV with British Gas. There's a real positives in the market. And one of the biggest drivers here, I think, of the total cost of ownership is fuel. Now, some of the European markets do not have the advantage that we have in electricity prices and also the availability of charging. So first of all, I want to look at charging stations, and then I'll look at electricity prices on how you're able to charge these vehicles. And then we'll look a little bit on some of the highlights of vehicles coming towards us over the next maybe 6 to 12 months. So first of all, charging stations. Now, this data is from a company called ZapMap. They take a lot of, they have an amazing database of charging points across the UK. And you can see from 2011, when there were very, very few charging points, to today and year to date 2020, when actually there's even been growth through this awful year affected by COVID. There has been a growth in new, and these are wholly new, not just replacement. Sorry, I was referring to Donald Trump's wall then. So these are new charging stations moving forward. So there's different ways of being able to charge an electric vehicle, from slow, which is pretty much the same speed as charging from a 3.3 pin plug, to fast, which is up to 7 to 22 kilowatts, rapid, which are the ones we see up and down the motorway, sort of 25 to 99 kilowatts. And then the ultra rapid, which are the newest chargers and some of the fast chargers. So some of the, maybe if we look at the Porsche Taycan, some of the new e-tron vehicles are able to charge at ultra rapid, and even new Skoda will be able to take advantage of some of these chargers if you have the particular options on the vehicle. So there's been a real growth in the ultra rapid, which is fantastic news. The rapid chargers, which are probably become the most prolific across the UK for the in-journey charge when you stop at a service station, stop at a hotel, if you like, and then the destination charges will be the blue, more the rapid chargers, where there'll be charge points maybe at the cinema once they open up again, and the shopping centres in car parks. So the changes been taking place this year. Overall, there are 35,030 connectors now, and with just over 20,000 devices. Some devices have more than one connection, hence the increase, almost the doubling in the amount of connection. And that's key, because there's still different technologies and different speed at which vehicles can be charged at. They're in 12,645 locations. Remember, these are public charge points, and we talk about when we talk charging infrastructure, we're talking about the public locations that are available to drivers to charge from. And then even in the last, the last 30 days, 444 new chargers up until 4th of November have been opened up for use. Now this is amazing, really, because this is all driven by private companies opening up to develop the charging infrastructure in the UK. Now, I talked before a little bit about electricity prices, and this is just a very simple graph. I'm sorry, it's a little bit messy. If we look at if you charge your electric vehicle, the average peak rate, according to Ofcom, is 12.1 pence per kilowatt. Okay, bearing in mind the old 2017 model year Leaf was a 30 kilowatt battery. Battery sizes now are just growing significantly. Some of the Teslas are really, really large now. But if you look at the average off-peak, it's actually only 8p a kilowatt. In the old-fashioned term, that would be economy 7. So if you charge at night, you set your smart charger or you set your timer on the charging vehicle, and it will take advantage of that very low off-peak rate. Now, when you charge outside, you'll charge at maybe the service station where it's 30p a kilowatt, or you'll take advantage of membership of one of the newer companies that's around to be able to charge your vehicle. Now, one of those is Ionity, and they've got a very close relationship with Volkswagen to start off with. But if you're not an Ionity member and you just use, I think, an app, it is 69 pence per kilowatt. Now, Ionity is a growing network. It's not the largest yet, but it is a growing network. As a basic member, you pay £5.99 per month, and the electricity price comes down to 45p a kilowatt, and a premium member, £13.99 a month, and the price comes down to 25p a kilowatt. Now, the charging infrastructure that I use most when I'm out driving is BP Polar. BP bought Polar in 2018, I think it was, and their unit price depends on the charging speed that you take advantage of, but also the way that you pay Polar for the privilege of using their charging structures. Now, the cheapest way is to use contactless, just using a payment card. And for a 50 kilowatt charger, it's 30 pence per kilowatt. And for 150, one of those super rapid, ultra rapid chargers, it's 40p a kilowatt. For Polar Instant, and this is just by using an app, you put money onto the app and it uses your deposit, and you can charge at 18p a kilowatt from a slow charger, 25 for a rapid, and then 35 for an ultra rapid. The minimum cost that it would be £1.20. Now for Polar Plus, it's £7.85 a month, so a little more expensive than the basic membership of Ionity, but significantly less than the premium member. And you will gain so for the fast charge, 12p a kilowatt, 15 kilowatt for a rapid charge, or 150 kilowatt at 20p a kilowatt. So it is a little bit complicated, but I think they're all trying to simplify their tariffs and how they charge their customers. But certainly once we're out of lockdown and perhaps able to drive to meetings more often, it's certainly worth, from an EV perspective, just to have peace of mind. The Polar Plus, or at least the Polar Instant, is certainly worth looking into. But most of all, and I think we'll see this on the majority of vehicles, both if LCVs are able to charge at home, if they have off-street parking, but especially cars, most charging will take place at home. And certainly the sensible EV driver will be looking at being able to look at using off-peak as much as possible. So I just thought that was an interesting look at how, especially in the UK, the cost of ownership of EVs can really be quite beneficial as you look at the different costs of electricity. For instance, in Germany, unfortunately, they I think are at 45 euro cents per kilowatt for their average average supply rate at home. So some of these charges, and they're similar in terms of euro cents per kilowatt. The Ionity is, I think, 85 cents per kilowatt, the basic. So actually it's very similar charges to their home potential for their electricity prices. In terms of coming soon to a socket near you, there's a lot of new vehicles coming out. I've just highlighted possibly some of the most important. A lot are coming from PSA, which is great news for both Vauxhall, Peugeot and Citroën. Volvo have got the amazing XC40 coming soon. These are all amazing vehicles. I've driven quite a few of them now. I've not driven the Rivian R12, which would be great because it's a sort of full-size pickup truck, but in competition to Tesla's sort of truck that they launched. They started to launch the concept of last year, so that's going to be quite interesting. Model S, Model X, potentially higher, longer range vehicles coming on and faster. They're talking about the Model S being a competitor for the Taycan Turbo S. The number of Audis coming out, the smaller version of e-tron, and then the e-tron eGT, so the Q4 version is going to be a very interesting car from Volkswagen Group. There's a nice thing there from the Pininfarina, the Battista. Obviously, that's a great supercar. The Tesla Roadster, which will replace Starman's Roadster, which was launched into space. You know, remember the Lotus-bodied Roadster that Tesla first came out with. Skoda Enyaq comes early next year. Fiat 500, we've got the data for already. Ford Mustang Mach-E, that's an amazing car. The Tesla Model Y, interesting styling, not necessarily everyone's taste. It's about the same size as the Model 3. And for the bargain basement, and frankly, one of the cheapest cars here will be the MG5 EV, which is between a Focus Estate and a Mondeo Estate in size. It's a really quite an interesting vehicle. It's an EV. You will get all the cost of ownership benefits here. That is going to be a very interesting vehicle to really start to see where the market is going from a value perspective. Obviously, this will be MG's second full EV, and will run alongside their FEV that they've recently launched as well. So some really interesting electric vehicles coming our way over the next few years. But just look at a quick summary. I've had you now for just over 30 minutes. There are destabilizers. The second lockdown in England, probably followed by some kind of tiering system in England. Obviously, that's already in place in Scotland with their 5 tiers. Brexit is a destabilizer, but as I said, we will be following that very closely from both a data perspective and also what it's going to do with values and RVs moving forward. Stock availability is an issue for new and used. A number of manufacturers are increasing their stocks in the UK, so they have stock next year that will potentially not attract if we do exit Brexit without a deal. They want to bring in stock as they can. That isn't going necessarily to plan because of the coronavirus and slowdown in production, but they're doing as best they can as far as we're aware. From a remarketing perspective, ready-to-retail stock is still in the highest demand, and that is across all of our vehicle types, from car, LCV, motorhomes, caravans, and motorbikes. It's what is best stock, and dealers want to move stock as quickly as possible. And from a BEV perspective, new launches, more chargers, less range anxiety. It can only be a good thing as we move forward, but BEVs are still only a small amount of the market. PHEVs and real hybrids, true hybrids, are still quite a high proportion, but diesel, especially in the used car market, is still one of the fastest selling vehicles. So diesel still has a place, especially in the LCV market, where it's predominantly around, I think it's around 98% of the market, with the PHEV from Transit Custom and the small amount of full electric vehicles moving forward. So thank you very much for your time. I've got some questions. If I take a look at my question panel, let's see what I can see. So I've had a couple of questions. Ready to retail is you're right. So the question is ready to retail the most in-demand type of stock? It's not. But a lot of the trade are looking at ways. I mean, in terms of the Mazda MX-5 and the Audi A4 Cabriolet, that really wouldn't be the normal kind of vehicle that you would be remarketing at this time of year. But actually, if you have that type of thing in your stock, I'm not saying get it in stock for December because the think values will fall, but we've got to think outside the box. This year is not normal. It is unprecedented. Things have happened that we would never have forecast. So looking for the best stock, yes, you can make repairs, and especially if you've got an on-site repair, it's great, or Dentmaster can come in and fix some very quick repairs. But sometimes it's having that stock available, because customers are just looking for, if they want the best possible service, you're going to have to embed that trust into your customers. And quite often online is a little bit harder. Online used is very hard because you've got to take the right pictures. You've got to show where the damage is. If it's got as little damage as possible, people will buy that vehicle from you. Another question, when do you think we might see parity between BEV and ICE vehicles in terms of new sales and percentage of entire car park? Oh, that's quite interesting. Percentage of entire car park, that's going to take a number of years. It's still only 2040 when ICE car sales end, or ICE in general ends, and it will be significantly beyond there by the time we can reduce the car park. We may see scrappage schemes come into play. That will be quite interesting to increase the penetration of BEV or beyond BEV, whatever comes next, potentially hydrogen. But again, we'll have to look again at infrastructure as we move forward with hydrogen. But parity in the car park will take an awfully long time. Yes, there are companies out there converting classic cars. It used to be taking lead out of engines because of the lead in fuel, sorry, not out of the engine itself, but removing lead from petrol was the first step for classic cars. Maybe the next step will be more conversions to BEV. We've already seen E-types, we've seen transporter T1, T2s and T3s, I think, in terms of the vans. I've not seen a T4 electric van yet, but it's quite interesting, and a lot of conversion companies are looking at this as a possible route forward, and this would speed, although just a little bit, the move to parity in the car park. Even looking at some old Leaf, Leaf is one of the interesting BEVs that actually you can update the batteries, because the new Leaf is effectively only a top hat, so the body changed, the underneath part of the vehicle didn't. So the space for the battery version between version 1 and version 2 is identical. So you can get a larger capacity, a higher kilowatt battery into an old Leaf. So that's quite interesting for renewal of older electric vehicles, so increasing range, perhaps of the 24 or 30 kilowatt Leaf up to more of the 40 or the slightly higher 60 something kilowatt battery. But yeah, in terms of sales, I think BEV will increase. It will increase quite slowly. We will need more input from government, although they've asked us to do it as an automotive industry to do it on our own. I think there will need to be more taxation incentives to get company cars increasing, to get the penetration or the availability from manufacturers into the UK, because we're still not a particularly profitable market to sell an EV in. So that again is going to take time. They're looking for in 2030, 70% of the cars sold to be ultra low emission, which predominantly means BEV. So at that point, we should start to see it towards the end of the 2020s, but it won't be anytime soon. I think from an environmental perspective, it probably needs to increase more rapidly, and we need more help from the government. It's great, we've got another question here. There's going to be quite a lot of people moving forward with BEVs. So hopefully, as we see more BEVs penetrate the market, we'll see again more in our leasing companies, but especially at retail. So BEVs will start to increase quite significantly as we move forward, as more are launched. Just the last slide here, just a reminder that you can contact both myself, Tim Budgeon, our sales director. He's sort of waiting for your call. You can email him. I've added a hyperlink. If you download the PDF, you can email Tim. He's our sales director, or you can email Paul, our business development leader, and he's available to help you out with any questions you might have. Some of our data today that I've used came from our European tool, which is called Residual Value Intelligence. And we can set up a free demo of this if you'd like. But if you have any further questions, please contact any of us via LinkedIn or any other means you might find. My email address, there's a number of email addresses here, but please stay in contact. We will continue to update the profile. We're looking at doing another one of these webinars in December, just at the beginning of December, so we can look at how November affected sales, how the used car market really looked, and really try and look at what we feel will be the best sort of route forward for next year as we look at residual values moving forward and how the market will react. But for now, thank you very much. Good luck. Stay safe in lockdown, and I hope to see you all soon. Thanks a lot. Bye-bye.